Ways to crush the stock market. Welcome to Everyday Elevate, where we're dedicated to helping you crush the stock market with savvy insights and strategies. Today, we're diving into the art of identifying stocks set to outperform. If you're keen on strategies that promise quick riches, you won't find them here. Instead, we're channeling the wisdom of investing legends like Benjamin Graham, Warren Buffett, and Bill Miller, who advocate for a patient approach to wealth building through value investing. Join us as we explore how to uncover superior companies trading at bargain prices and patiently wait for their true value to be recognized. This isn't about overnight success. It's about long-term market mastery. If you're ready to crush the stock market, hit that subscribe button and join us on Everyday Elevate for weekly insights and strategies that will empower your financial journey. On to the video. Here's how we identify stocks that are set to outperform. If you're looking for a get-rich-quick strategy, value investing is not for you. Because value investing, as practiced by Benjamin Graham, Warren Buffett, and Bill Miller, to name a few, is all about getting rich slowly. The formula is simple. Find superior companies, buy them when they're on sale, and patiently wait for the market to recognize their true value. It's the only time-tested strategy for long-term market success, but it won't make you rich overnight. Find a great company. Our approach to selecting recommendations aligns closely with Warren Buffett's strategy rather than Benjamin Graham's. Where Graham sought out cigar-butt companies trading below asset value or at low earnings multiples, Buffett favors relentless growers, companies with entrenched market positions that consistently generate substantial cash flows over time. At Inside Value, our analysis begins by deeply understanding a company's core operations and competitive edge. Similar to Buffett's criteria, nearly all our recommendations hold dominant positions within their industries, creating formidable barriers to competition. For instance, companies like KFX in energy solutions offer exciting growth potential in dynamic markets, but also carry significant execution risks. However, our focus predominantly rests on identifying relentless growers poised to deliver sustained growth over the long term. Take Dell, NYSE Dell, a recent Inside Value pick. Despite facing competition from major brands like Hewlett-Packard, NYSE HPQ, and smaller players, Dell maintains a commanding 18% share of the global PC market, supported by efficient logistics that enable unparalleled pricing advantages. Expanding into new markets such as televisions further underscores its growth strategy. It's crucial to note that our emphasis on dominant market positions doesn't necessitate recommending only mega corporations. While our largest picks exceed $200 billion in market cap, we've also endorsed 12 companies across various sectors, with market caps under $3 billion, reflecting our commitment to identifying robust, scalable businesses positioned for significant future growth. Understand the risks. Once we've identified a completely dominant company, we analyze the risks to that company. After all, even dominant companies have risk factors that can potentially slow their growth. At one time, Glenair Technologies, NASDAQ GEMS, had a leading position in the paging market and seemingly unlimited potential to profit from new technologies. But the company was unable to adapt when wireless phones became popular, and Glenair has been struggling to redefine its niche ever since. And such displacement doesn't just happen to technology companies. For decades, newspaper companies like New York Times, NYSE, NYT, and Tribune, NYSE, TRB, have had near monopolies over print advertising in their local markets. But the internet has changed the game, leaving these companies scrambling to adjust to declining readership and falling ad rates. So the next step in our process is to carefully examine any risks the company faces. We'll consider issues such as currency and interest rate fluctuations, debt loads, regulation, loss of critical customers, market changes, potential pricing pressures, litigation, and key personnel changes. Price the stock. After we have a great understanding of the business, we conservatively calculate its intrinsic value using methods such as a discounted cash flow, DCF, analysis. If the company seems like a huge bargain, it becomes a recommendation. If it looks cheap but not quite cheap enough, it often will be added to the watch list as a potential value play should its price drop. We take valuations seriously. We only recommend stocks that we believe are significantly undervalued, and we discuss in detail the fair value of each one. On average, our picks were trading at prices equal to 72% of their fair value when they were recommended. In other words, if these stocks simply returned to fair value over the course of a year, investors would earn about 40%. Of course, since we're generally buying relentless growers, each company's fair value is likely to have increased after a year as well. In this episode of Everyday Elevate, we've explored the fundamentals of value investing, as advocated by investing legends like Benjamin Graham and Warren Buffett. We emphasize a patient approach to identifying superior companies trading at discounted prices. Our strategy involves a thorough analysis of a company's business fundamentals and competitive advantage, akin to Buffett's focus on relentless growers rather than Graham's bargain hunting. We discuss the importance of understanding and mitigating risks, ranging from technological shifts to regulatory changes, and concluded with a methodical approach to valuing stocks using discounted cash flow analysis. Ready to enhance your investing strategy? Subscribe to Everyday Elevate for weekly tips and strategies that will empower your financial journey. Hit that subscribe button now, and let's navigate the markets together.